Now guys, we move to the next topic, which is selection of PLI in case of TNMM. Now first of all, PLI means profit link indicator. We'll understand in this particular section of this video that what is PLI and how the base, so consideration of base for selection of PLI and types of PLI which can be considered. So there is also an OECD advisory on or OECD guidance available for selection of PLI. PLI basically is a profit link indicator. That is what we say PLI. So what is PLI? PLI is just basically a financial indicator, right? That is a ratio to compare the controlled transaction with uncontrolled transaction. That is what in simple term PLI means. Now consideration of base for selection of PLI. Now we need to consider following things when you select the PLI which is to be used as indicator to compare the profits or margins of your taxpayer entity with the comparable entities, right? So what are this part? So denominator reflects the allocation of risk between the parties. So if there is an operating profit by operating cost, right, or operating profit by operating revenue, then the denominator technically should reflect the allocation of risk between the parties, right? So let me just give an example. For allocation of risk between the parties, suppose now suppose your risk are more towards purchase, right? Then under your denominator your cost will be there, right? Operating cost will be there, or the cost base denominator would be there, any of the denominators. We will see that what type of PLI we can use. So in case if your risk more sort of lies, the parties do share the risk in the sales area more, right? Then your denominator would be lying on the sales end, right? So your numerator would be your profit, your denominator would be your operating revenue or operating cost. We'll understand this once when it comes into the practical part. Then the next consideration is base should be independent from the controlled transaction, correct? So if you have purchased goods from your associate enterprise, then technically we will take independent denominator, that is the sale part, right? So your operating revenue part will be denominator, not your operating cost. So this could be scenario where you would have purchased the goods. Now in case of sale of services to your AE, right? In that case you will generally use OP by OC, that is operating profit by operating cost. So these are two considerations. We will understand that with the help of OECD's guidance as well. So if you see para number 2.93 of OECD transfer pricing guidelines, what it says is that the denominator should focus on the relevant indicators of the value of the functions performed by the tested party in the transaction under review, taking account of its assets and risk assumed. See what I said, that denominator reflects the allocation of risk between the parties. Now typically, and a subject to review of facts and circumstances of the case, sales or distribution operating expenses may be appropriate base for distribution activities. Full cost or operating expenses may be appropriate for the base, for a service or manufacturing activity, right? So now under service or manufacturing activity, your risk will more lie on the service delivery or say purchase cost, manufacturing cost, etc. So at that point of time your base should be, denominator should be your cost, right? But if you are a distributor where your entire risk lies on the distribution end, then your base should be sales, right? So that is how the focus on denominator should be there, right? And operating assets may be an operating base for capital intensive activities. So if it's a machine manufacturing unit or industrial machinery manufacturing unit, then you can also choose the base as total capital employed or assets employed. We'll see what type of PLIs do generally the taxpayers use, right? So that is where the first 2.93 para comes up. Now the second para says 2.94 that the denominator should be reasonably independent from control transactions, otherwise there would be no objective starting point. So as I mentioned, you can also read the example here under para 2.94, which technically says that your denominator should be free from that should be independent from control transactions. So if you have done a purchase transaction with your A, Then under denominator, your sales should reflect, that is operating revenue should reflect. Now we'll move ahead and we'll understand that what are the types of PLI. I'll just open that. So types of PLI which can be considered when you undertake the TNMM analysis, right? So this is operating margin. So profit level indicator, we generally say operating margin, and numerator would be operating profit and denominator would be operating revenue or operating cost, as we also saw in that example that we were taking OP by OR or OP by OC. So that could be one of profit level indicator. The second thing could be return on operating assets. So again, a numerator would be operating profit and denominator would be operating assets. So in that capital intensive industries that we saw, so you can take such type of PLI depending upon your case, that what will be the most suitable PLI for your entity, as also which can give you reliable comparable results. Then return on capital employed, that is operating profit by capital employed. So at times you can take this type of PLI also where there's a heavy intensive industries. Then return on cost of goods sold, so gross profit. Now here you under probably this is not under TNMM which you should take, but return on cost goods sold is basically gross profit divided by cost of goods sold. So probably in CPM you can go ahead and you can take this type of PLI. So under CPM also you can decide a PLI as well. It's not always operating profit by operating cost, but under CPM where you are required to understand gross profit, then gross profit divided by cost of goods sold. Now Berry ratio. Now Berry ratio is, I think this is used much on distribution entities. So when only distribution activity happens, then Berry ratio is used, that is gross profit divided by operating expenses. You may search on Google that in which cases this Berry ratio is used. There are also, I think, judgments, and this ratio was identified by some of the economists only. You can read that where you can use Berry ratio as a PLI. We generally don't use that, but in certain cases people have used that, and appropriately that PLI has also been upheld by the courts or has been also given under the OECD guidance. You can check that. And cash profit ratio is basically when you earn a cash profit, that is you reduce the value of depreciation from your operating profits, that is what the cash profit means, and you only include the cash expenses, that is all the the provisions are reduced. Apart from depreciation also, all the provisions are also reduced from the that particular set of expenses, and that is where you arrive at a cash expenses. So I have not we have made depreciation adjustments, but that's a different thing. But cash profit and cash expenses could be used probably in the practical scenario. I have not come across any such case where you can use this ratio, but yes, in your case, if that is applicable, you can go ahead and use the cash profit ratio as well. That is where you identify the actual cash profit from the activity. So it could be in the cash oriented business where you can which has the instant cash where you can receive the instant cash. So such models, business models where instant cash is generated and instant cash is paid, probably on websites or e-commerce websites. This could be used, but we would always recommend to go ahead with the general presumption and general utility what people are using as compared to the specific such type of ratios. In general, I have at most times, like 90% times the PLI would be OP by OC or OP by OR, depending upon the the two factors which were discussed above. But you can also go ahead and use the other ratios also. This is just for your information I have given you. You can research it on yourself, and then appropriately you can understand that what particular PLI that you can use in your case. I hope that clarifies. Now I'll just meet you in the next video where I'm going to explain you how to arrive at arm's length price in the TNMM dataset, as we have already seen that, but I'll again explain that. And apart from that, I will also explain you that how a segmental profit loss can be created out of the entire profit loss account. I'll see you in the next video. Hope you're enjoying this entire learning process. Thank you.